My guest today is Andrew Wilkinson, co-founder of Tiny. Tiny is a long-term holding company for internet businesses. They take majority, generally whole stakes in profitable, simple, and often boring internet businesses. Thanks a lot for coming to the HoldCo Builders podcast, Andrew.
Thanks for having me. It's great to be here.
Whenever you read about people like Bill Gates, Steve Ballmer, Steve Wynn, they're all pretty old today, and but these people, they were all very ruthless in their early days, especially when you read the books about the first 5 years of their businesses, compare who they are today. So my goal today is to really understand who was Andrew maybe 20 or 15 years ago. You're still young, but you started very young. Who was this Andrew when he first got started, this ruthless, focused guy wanting to build a big business? So that's the goal today.
That sounds great. That sounds interesting. You can psychoanalyze me.
Yeah, so the first question is, who were you in your early and late 20s when building your first businesses and agency, to be exact, and how would your colleagues and friends describe you, and what were your strengths, weaknesses, and how were your days look like?
By the way, is this video podcast or no?
Video.
Yeah, okay. So I think it's more interesting to go back to my childhood. When I was a kid, my dad was a struggling entrepreneur. He had his own architecture firm, and money was always tight. And so my parents would always fight, and there would be a lot of tension in the house around money. And so when I was a kid, from the time I was little, I always thought I need to get money so that everyone will stop fighting and all my problems will go away. And so for my whole life, I've kind of been obsessed with money and making it. And I stumbled into business. I always knew I wanted money, but I didn't know that business was the route there. And so when I was in high school, I started a tech news site. I was just on my computer one day, and I met two kids in a chat room, and we decided to start a Apple technology news site. And it started doing really well. And I started selling advertising on the website and making thousands of dollars a month, which when you're in grade 10 is a big deal. And so I did that all through high school. And when I was about 18, I went to my dad and I said, "Dad, I'm not going to go to university." And I remember we were driving in the car, and he slammed the brakes on the car, pointed at a gas station, and told me that I'd be working there for the rest of my life. So we kind of duked it out. And he said, "Look, you're doing this journalism stuff. Why don't you go to journalism school?" And so I ended up giving up the website to my business partners and moving away to college. And when I got to journalism school, I just pretty quickly realized it wasn't for me. I did not want to go write for a newspaper. You know, this is in 2004. All the newspapers were going out of business, and I was feeling very lost. And so I ended up dropping out, and I got a job as a barista to pay my rent. And these two guys would come into the coffee shop I worked at all the time, and they would just sit there on their laptops. And one day I went up to them and asked them what they did for work. You know, don't you guys have jobs? How do you just sit here all day? And they said they're web designers. And I asked them how that worked. And they said, you know, we just go into local businesses and we see if they have websites. And a lot of companies and small businesses, of course, didn't have websites. This is in 2005. And so they were very successful doing that. And that sounded pretty easy. That sounded like something I could do. And so I went and I bought a book on web design, and I walked into a pulled pork barbecue joint a couple weeks later. And, you know, the guy said, "Sure, I'll pay you $500 to make a website." And very quickly after that, I started working with Silicon Valley startups. I actually found a job board. I got really lucky. I found a job board where startups would post work they needed done. So they'd say, "We need a product design or something coded, just contract work." And I just emailed every single listing that ever popped up on there. And nobody responded except for one guy. And he paid me $5,000 to do like 8 hours of work. And from that moment, I was like, oh my God, this is incredible. I'm doing this. Forget being a barista. Forget anything else. I got obsessed with web design and building an agency. And so that was really where I started.
And what about your father? I guess he was one of the first people who got the call when you said that, okay, this could, I can make some serious money with this.
Yeah, I think my parents were really worried. I think that they didn't really know what I was doing. They were a little bit nervous about me starting a business, and they were always, I think, probably for the first 10 years of my career, I think they were a bit concerned. And then finally, I think they realized like, oh, this is a real thing. You've got a real solid business. But it took a while, and they were pretty worried for a while.
And how was the first year, first 18 months? Because you're in Canada, but you're pretty much charging US prices. So this is a massive difference.
It was amazing. I mean, I was billing in US dollars, and a dollar US at the time was worth $1.30 Canadian. So for me, I'm paying contractors here in Canada in Canadian dollars, and I'm billing them out at US dollars. And so I was able to run a much more profitable agency than would be typical. And when I started making serious money, I didn't really know what to do with it. People would tell me I needed to invest in real estate and stocks, but to me, that was something for guys in suits. It wasn't something that I was interested in, not something I understood. And so I just started a bunch of businesses. Every time I'd have a business idea, I would just start it without thinking about it. I wouldn't do any analysis. And so, I started a skincare company. I started a pizzeria. I started an online DJ school. I started a designer cat furniture store. You name it. I've started a lot of dumb businesses. And I think it was really, really good training. Buffett has this great quote: I'm a better investor because I'm a businessman, and I'm a better businessman because I'm an investor. And I think that was my time to really recognize the power of a high quality business and a good business model versus a bad business model. And unfortunately, I did it by learning the hard way and starting all these businesses and going through that. And so I did that for about 6 or 7 years. And I got to a point where I was the CEO of like 6 companies at the same time. My time was totally fractured. I wasn't doing a good job across any of them. And I was really unhappy. I realized that I couldn't just keep starting more and more businesses. That wasn't going to scale. And so I took a bit of a breath, and I went and I finally decided I would learn about investing. And I'd always heard about Warren Buffett, but I didn't really know anything about him. And so I read, The Warren Buffett Way. And I was just blown away by this whole concept that not only can you delegate, work to your employees, but you can actually delegate the operations of a company to a CEO. That was something that I hadn't ever realized. I'd always thought that I had to be the CEO. And so as soon as I got out of the way from the CEO seat and started hiring great CEOs and incentivizing them well, all the businesses started doing way better. And I realized that, like Buffett, I wanted to go buy businesses instead of starting them.
And when did you realize that it's a better idea to buy and build those businesses by finding great CEOs versus just focusing on this one business and growing it? Because you've said this, the reality is that it's easier to buy and improve businesses than start them. It is easier to go from 3 to 10 than from 0 to 1.
Yeah, I think it's not always better to buy a business than to start one, but I think it depends on your skill set. And I think that, if you think about it, if I traveled back in time today and gone to my 18-year-old self and said, don't start businesses, just buy them, I think I would have been an incompetent buyer because I didn't know what a good business was and I didn't know what a bad business was. So I think it was really important that I had that time in the wilderness, failing and starting different businesses and learning different business models, because it gave me an eye for what a good business looked like when I was buying them. And so I think that people kind of have to go and get those reps and experience. I think one of the problems with a lot of investors in private equity is that they've only ever been taught that a business is a spreadsheet. And a business is not a spreadsheet. A business is a group of people, and people are incredibly complicated. It's systems, it's competitive forces, it's people. There's a lot of nuance to a business, and so I think it's important that people go and get that experience. So while it is easy to buy a business once you have experience, it's not easy to buy a business if you have no experience, because frankly, you'll buy a bad business.
And now 6 and 7 years running the agency business, it's produces a lot of free cash flow. What was the first, second, third acquisition? And maybe you can share a bit about the structure, financing, maybe how much debt you were using, and maybe pricing, maybe overpaid, maybe you just got a very good deal.
The very first one that we did was a business called We Work Remotely, and it was a job board that was started by Jason and David, the guys that run Basecamp, and they had written a book called Remote Office Not Required. They were about 10 years early. It was all about how you can run your company remotely and you don't need to have an office. And as part of that book launch, they had started weworkremotely.com, which was a job board for companies that hired remote, which was very unique at the time. And I had used it to hire people and was familiar with it. And I'm friends with Jason. And he just texted me one day and said, "Hey, I don't know what to do with this job board. We're too busy running Basecamp." I mean, Basecamp is like $100 million recurring revenue software business. And they had this little tiny job board, and it was making about $500,000 of revenue per year. But it was highly profitable. They barely touched it, and every dollar was basically profit. And so he said, "Look, would you want to buy this thing?" And he said he wanted 1.5 million. And I looked at it and I saw that they hadn't increased pricing and kept up with other job boards. So they were charging $199 per job posting, but a lot of the other job boards were charging $299. And they weren't doing any marketing or SEO optimization. And so I looked at it and I went, worst case, I pay myself back in 3 years. Best case, I can come in, pull a bunch of levers, improve the SEO, improve the pricing and stuff. And that was what happened. We ended up buying it for 1.5 million of cash because we were quite cash rich at the time. And we made all those improvements. And, a couple of years ago, it's a cyclical business, but a couple of years ago, that business made $4 million of profit in 1 year. So it's been an incredible acquisition for us and, very successful. And what I like about that deal was, as a first deal, it was highly certain. It was very low risk. We really just had to ask ourselves, would people continue to post on this job board for 3 years? And I think the answer was yes. And then if we could do these 2 or 3 simple things, we could de-risk the acquisition completely and pay ourselves back in 1 or 1.5 years. And so it was a great one. And it was the equivalent of walking into the gym and starting really small. We just bought something really tiny and then we figured it out from there.
Today, your portfolio of internet businesses, but has it been always like this? Because I think when you're, at least that's what I believe, you're doing extremely well. You're pretty confident. Were you looking at other industries as well? And people, once you did the first one, people started sending you different deals, or you've been able to stay pretty focused and focusing only on internet businesses?
So when I read about Warren Buffett, I got excited about traditional businesses. And Chris and I, my business partner, and I started looking at everything from fence rental companies to porta potty businesses to crematoriums, gravel pits, all sorts of different businesses. And we, over and over again, would meet with these founders and they would tell us huge revenue numbers that blew our minds, right? They'd say, "We do $100 million of revenue." And Chris and I would be going, "Oh my God, we only do 15. This is going to be a huge business." And then we would look at their profit and loss statement and we would see that at the end of the day, they'd maybe make $1 or $2 million of profit. And often the profit had to go back into the business to buy more trucks or to do CapEx or something like that. And so pretty quickly we realized that, oh wow, these internet businesses are pretty awesome. If you have $1 million of profit, that's probably at least $700,000 of cash in your jeans in dividends at the end of the year if you want it to be, or reinvestable cash. And so we started really focusing back on internet businesses, and we realized that we had an unfair advantage in that that was our expertise, that was what we knew how to optimize, and also that was what our network was. So when we bought businesses, we knew the founders often, we had a reputation in the tech world, and we knew great operators. Whereas if we went and we bought brick and mortar businesses, well, we really didn't know anyone in that world. We were kind of the patsy at the poker table. If we were buying a crematorium, we didn't know the first thing about that business, but we knew a lot about something like a job board.
Now, once the first acquisition was done, I guess the belief went up because you've been reading about investing, Warren Buffett, and now you did it yourself. It's very different from starting a business from scratch. So how was the next year, next two? Did you go on a shopping spree, or what happened next?
No, we kind of have moved. We'll have long periods of doing nothing, and then we'll have sudden moments of activity. And so I think maybe 6 to 12 months later, we bought Dribble, which is a large social network for graphic and web designers. And I'd actually used Dribble for years to hire designers and find work for my agency. And so I was very familiar with it. And the co-founder of it, Dan Cederholm, had actually written the book on web design that I had learned from. So I was kind of obsessed with him. And I just started calling him up and asking him if he would sell. And every 3 or 4 months, I'd send him an email and just say, hey, has anything changed? I just wanted to check in, no pressure, but if you ever want to sell. And I stayed on his radar. And one day he just called me up and said, hey, can you fly to Boston? I want to meet with you. And so Chris and I flew to Boston and negotiated a deal to buy that business. And that was one that was much more Buffett-esque. So buying WeWork remotely, we were buying a pretty high quality business, but there's really no moat in job boards. If you have job board A and job board B, there's not really any reason why someone would post on your job board versus LinkedIn or whatever. It's kind of a commodity. So it was a cheap business for a reason. With Dribble, it had what I would call a network effect moat, in the same way that you don't want to go on, an alternative to Instagram because all your friends are on Instagram. It had a competitive moat. There wasn't really a lot of competition. There was one other social network, and it had been acquired by a large public company, and wasn't really evolving. And so that was one where we paid up, and we're really scared. We paid about 10 times earnings to buy that business, and we felt that it was something that if somebody raised $1 billion of venture capital and decided to compete with it, I think it would still be hard. I don't think it would be easy to compete with this business. And so we felt comfortable paying up because we're getting something unique. And I think Dribble, looking back, was similar to WeWork Remotely in that the founders were very focused on the product, but they didn't really spend any time on growth and marketing and monetization. And so we were able to come in and significantly increase the advertising revenue and build a whole bunch of new revenue lines, and then also do some M&A using that platform. And we're able to grow that also very significantly. We bought that business for about $10 million, I believe, in 2016, 2017. Yeah, these are inexact numbers. And that now is you could look at our public filings. It's well into the single digit millions of EBITDA. So if you think about it, we paid 10 and we're making 50, 60% annualized return just in dividends right now.
That's crazy. Important thing you mentioned, that you and Chris having this patience of not doing something for quite a long time and probably not being too worried about this. Where did this come from? Because I think, especially when you're young, you want to get those deals done. From where did you get this? That, okay, Chris, we should just wait for this next great deal?
it's usually when we talk to people and over again, they say crazy numbers. So it's not really about, we always get deal flow and see opportunities, and we see businesses that we love. The problem is that the founder is not usually willing to sell at a rational price. So in 2020, when the stock market was crazy and venture capitalists were giving every company under the sun billion-dollar valuations, we would have someone with a $2 million revenue business say they wanted $100 million for it. And so there was just no way to productively engage in deal making at that point. And so usually when we have a period like that, we just kind of cool it for a while.
You've said that the businesses you want to buy or desire to buy, you describe those businesses as New Zealand companies, New Zealand businesses. What is a New Zealand company?
So New Zealand is an interesting country in that it's in the middle of nowhere. No one's paying attention to it, but it's quietly successful. And because it's in the middle of nowhere, it's also not at risk of nuclear war. It's totally self-sufficient. It is food and energy independent. And so if we just adapt that to, business, so if you think about it, we want a business that is not sexy, that not a lot of other people are looking at. And the reason we want that is because those are the opportunities to pay a fair price, right? If everyone is looking at something, you're getting an extreme price, typically an inflated price. It's also something that venture capital is not paying attention to, which is good. Because if you have a business where venture capital is excited about the space, they will then go fund your competition very aggressively. And so I actually like businesses that are not, billion-dollar rocket ships, because if you have a billion-dollar rocket ship, the VCs go, oh, cool, like those guys made $1 billion. We should go and fund 10 more competitors. And then we also want something that's kind of food and energy independent like New Zealand. So that would be something that isn't beholden to Google or Facebook or something like that to reach its customers. So in the case of Dribbble, a lot of the traffic was just people going to dribble.com in their URL bar. It wasn't people searching, how do I hire a web designer? And then they ended up at Dribbble so that, Google could disintermediate us, or, we're not reliant on like a YouTube channel or an algorithm or something like that. And then also just, I think profitability creates independence. So we're always looking for businesses that are totally profitable, don't need to raise additional capital. And yeah.
A bit of off topic. I know you're heading to New Zealand at the end of this year. Probably one person you should try to meet is the founders of Suru. It's the toy business in New Zealand. A family, I think it's two brothers and sisters, started it like 20 years ago. They moved from New Zealand to China, and today I think market cap, they're a private company, but between 10 to 20 billion. They're probably busy, but I think I'm not able to do an intro because I don't know them, but I've chatted a few words with Nick, and he's pretty open and transparent guy. So maybe you can have a meeting.
Cool.
Just
That's
an off
awesome.
topic.
Yeah, link. Send me afterwards. Send me an email. I'd love to meet those guys.
Yes. So, but knowing a lot of SaaS people, talking to them, internet entrepreneurs, these are the smartest entrepreneurs probably out there. So how easy or hard it is to find such companies like the acquisition you've done with Dribbble? Aren't they too expensive, or there must be some extreme luck that the founder is willing to sell it for cheaper price, selling it to you? Or how does it work? Because there are a lot of smart people out there chasing those deals.
Well, I think this assumes an efficient market. And this is something that I think a lot of investors don't understand, that ultimately these decisions are very emotional. And often, so speaking from my experience, when I started my business, I couldn't imagine selling it. If you told me that I should sell my business, it would be the equivalent of saying you should sell your baby for liquor money. It's unthinkable. But once I was 5, 6, 7, 8 years in, I was really exhausted, and I didn't know how to grow it. I got to a certain point, a certain scale, and I was tapped out. And I might have known what to do to grow it or had some ideas or people had told me, but I didn't want to do it. I was just so tired. And so if someone had come along at that point and said, hey, you can cash out and do something different, and I'll make it really easy on you. I'll give you all cash up front. I won't waste your time and do crazy diligence or make it into a 6 to 8 month process. I'm not going to lever up your company, all these complexities. And I'm going to treat your staff right. And I have a reputation for doing so, for leaving people alone. People are willing to sell at a reasonable price. And, I don't, to be clear, like the Dribble guys, for example, they sold at 10 times earnings, which for a business of that scale was awesome for them. And we were really paying up. But we did a bunch of stuff that they wouldn't have done. And they kept 20%. And I think the 20% that they kept ended up being worth more than the original deal. So it's one of these things where it depends on what people's desires are and what they want to do. And I mean, one of the most staggering statistics is that most successful small businesses are not sold, they're shut down. They are just shut down. They wipe them out, they just close the door and they close the bank account and that's it. And if that was an efficient market, that would never happen, right? And so I think that all it comes down to is relationships and reputation and figuring out psychology and what do people actually want? How do you design a deal that works for somebody? If I talk to a founder, I don't start by saying, what kind of EBITDA multiple do you want? I ask them, what are your biggest problems in the business? What's stressing you out? What do you want in your personal life? What does money mean to you? Do you want to buy a house? Do you want to buy a second house? Do you want to buy a Lamborghini? Or do you want to have just a stock portfolio? Or, I try and engage them in those questions, and then I can design a deal around that, right? And so if someone says, look, my wife is always bugging me because, I only have this one source of income, which is our business. And I love it. I want to keep running it, but I want to take some money off the table. Well, maybe I would go to them and I'd say, we'll buy 50%. You take all that money off the table. You keep running it and I'll leave you alone, because I understand founders. Founders want to be left alone if they want to keep running it. And so Buffett does this same thing, right? He leaves people who love their business running it, and he solves their inheritance for their kids or retirement or whatever it is that they want. And so we just do the same thing.
I want to talk a little bit about post-acquisition and this delegation part, because this is obviously a dream for 95% of entrepreneurs, business buyers, to buy a business, have a great CEO running it, but in reality, I guess it's extremely, extremely hard. So what do you usually do post-acquisitions, first 90 days? And who will run the business? Is the previous founder or the person from this team, or how does it work?
So most of the work is actually before we buy the business, and we generally will not buy the business unless we have a CEO who we really like, who can take the reins. The biggest mistakes we've made have been buying businesses and not having a clear leader on day one, where we're like, oh, we'll hire someone in the next 6 months, and it just kind of languishes. And so what we like to do is, generally, when we know we're going to buy a business, we will immediately start a recruiting process. And what I'm looking for is somebody who's run a similar business, same or similar business, double the size, and who has a strategy that I agree with and that I get a good feeling from. So when I meet them, I want them to come in and say, oh, I remember I joined this other company that's similar to this one when it was half the size. Here's the playbook I used to grow it to the size it's at now. And I want to be nodding along and going, oh yeah, okay, like perfect. Pricing, SEO, marketing, I want to agree with what they want to do. And then I want to leave with a good feeling from that person. And I've learned the hard way that there's a lot of really smart executives and CEOs, but if they're not like a great person that I want to spend time with, it will not go well. Either because maybe they'll be unethical or something like that, or just they'll be not enjoyable to spend time with. And I ultimately think that for me, it's really important to enjoy all the people I work with.
So a few questions. Before you were public, how were you incentivizing those CEOs? Equity versus salary and structuring the whole deal, and for how long they have to work there, or how does it work before you were public?
Yeah, so we've always done a variety of different things and experimented. And what we've found works the best is a base salary that makes them comfortable. So let's say that to have a nice house in the neighborhood they're in and send their kids to private school, they need a $250,000 salary or something. We, depending on the size of the business, obviously, we will give them a base salary that just meets those needs, nothing more, ideally. And then we'll have the rest as a bonus or equity. And generally, we love to just tie a bonus to a profit target or some kind of metric like return on invested capital. So saying, okay, if we bought the business for $10 million and the business earns $3 million in this year, that's a 30% return on invested capital. And great, you're going to hit a bonus of XYZ. And we just keep using that. Sometimes we've used targets. There's a lot of different ways we've done it. Now, if the CEO says, I need to own equity, we will usually say, okay, well, your total compensation, let's say between base and bonus, would be about $500,000. How much of that do you want to take away and put into buying equity? And what I like about that is that they actually care about the equity. Whereas if they get stock options, they usually don't value it as part of their total compensation, and they look at it as a lottery ticket, but it's extremely expensive for shareholders. And also, they don't really, it doesn't get valued. I don't know, like especially in a private business, there's no stock market ticker, right? It's a little bit different in a public company where they can have a trading account and see the stock go up over time or what their options are worth. But in a private business, that's very fuzzy. So I don't love equity. Can be very complex to administer both in a public company and a private company. I much prefer to just bonus people large amounts of money. But ultimately, we've realized that certain types of people need to be compensated with equity in some form or another.
But what about the scenario you mentioned? $500,000, the person decides to, let's say he really believes in this business. He wants 60% equity and 40 goes to base salary. What is the time horizon for this scenario? How does it work out?
Well, I would just say, okay, the business is worth 10 million and you're going to buy $250,000 of stock every single year, right? At that valuation or whatever the valuation is each year, right? So you just structure something. Now, you could do it with stock options or other things. I just love the psychological effect of, look, I pay you 500,000 and then you turn back around and you write a check to get the equity. Sometimes it's not tax efficient, so we sometimes come up with clever ways to do that. But I love you know, if you're the CEO, feeling that you've written a check, because to me, equity is not a free lunch, right? If you want to be a co-owner, then you got to buy your stake. And this is one of the things that really has worked about me and my business partner, Chris's relationship and business partnership is that he started out as my CFO. And instead of coming to me and saying, hey, I want to get 5% of the company, he came to me and said, hey, I want to buy in. And he wrote a check and he just kept, every year he'd buy more and more equity, or if an employee would leave, he'd buy them out with his own cash or whatever it was. And I like that. I think it creates true partnership and alignment.
And you've spoken highly of your partner, Chris. I've heard some of the interviews. What are your strengths and weaknesses when it comes to comparing you and Chris when it comes to the day-to-day of running Tiny?
Yeah, so the way I've got a book, and in the book I compare Chris and I to if we owned buildings and we weren't business partners. If I owned a building, it would be architecturally beautiful, incredibly well designed. It would be shiny and amazing, and people would love living there. And there'd be a lot of pride for me owning it. But it wouldn't make as much money. It would probably not be very profitable because I'm a designer and I love everything to be well thought out and well organized. And I will spend additional money to make sure it's exceptional. Chris would own a horrible derelict building that was almost embarrassing. He wouldn't want to say he owned it. And the people who live there would just get enough that they wouldn't move out. He's very cheap. And when you combine, and Chris would be a little bit embarrassed to say he owned it. So you put those two things together and you get something really special where I want to go and say yes to everything and to grow. And I want to, I want to make everything perfect. And Chris wants to dial everything back and get it hyper profitable. And so I think those two things kind of balance each other out really interestingly. And over time, we've gotten to a point where we both really see the validity of one another's perspectives. I don't think that, I remember we had a really fancy design agency, right? So people came to work for us because we worked for incredible clients and we had a great reputation for being a very high-end design agency. And I remember we were looking at a corporate office and I wanted to spend $10,000 a month. And Chris showed me an office we could get for $2,000 a month in a strip mall. And I was like, are you insane? Like, no designer is going to come work with us if we're in a strip mall. We should have our clients are going to visit us. That's embarrassing. Don't you get that? And at the time, he didn't really get it, right? And now I think Chris gets, the value of looking a certain way and paying up and paying for great lawyers and all these things that you should do. And I think I understand the value of just driving incredible amounts of profit to the bottom line in order to reduce stress and have optionality and stuff. So I think we've both kind of come to the middle.
So before going public, before IPO, how many deals did you do? How many companies did you acquire?
I think we're at about 30 or so, maybe more.
Do you ever sell a company?
Very rarely. We've sold one company and we bought it back. And then we have sold a few small businesses. Occasionally we'll buy something that is too small for us and we thought we could grow it and we aren't able to. And so we'll sell those businesses usually if they're a distraction.
And have you had to close any because of maybe something happened with the trends or just market dropped or anything like this?
I don't think we've had any that we've fully... Well, we have one. We bought this business called Designer News. And we thought it would be a great addition to Dribbble. And we were excited about it just because I'm a designer and I use the website. And we just realized that ultimately Reddit kind of destroyed it. So everyone just started posting on Reddit and then nobody wanted to use this special website. And so I think it might still, let me see if it's still alive. Yeah, no, it just links to We Work Remotely.
Okay.
So yeah, we shut that one down. But that's quite rare for us. I mean, we're not taking a lot of risk when we buy businesses. We're generally buying businesses that will continue to exist.
Okay, how connected are the businesses in Tiny? You mentioned 30 acquisitions. By today, you have more. How connected are those businesses?
Yeah, so our style has been to be very decentralized. We have generally not had the companies interact in any way. And I think it's very tempting when you own a conglomerate to start saying like, hey, let's synergize in all these different ways because we can save money and have shared services. But I think in practice, it's been something that has generally not worked for Chris and I. That said, Chris and I stepped down as co-CEOs and we put Jordan Taub in charge. And he worked at Constellation Software for years, and he's found some opportunities to synergize finance teams, a little bit of recruiting. And so I'd say it's shifting over time. Chris and I were very adamant about never having the companies interact in any forced way. We'd always say, if the companies naturally partner, that's fine, but we're not going to push them together. And Jordan may have a different approach to that. I think he's exploring some things, but usually we try and follow the Berkshire model of just leaving things to do their thing.
I want to discuss some of the tweets you have made. I read it to you. You did it like a few weeks ago. Something a lot of people miss. In tech, small things get big. Some of our best acquisitions, businesses that currently produce large amounts of cash flow in our public company, started out as 1 to 10 million investments. Compounding happens fast in digital businesses. Way too many people dismiss the fast growing or neglected the 500K EBITDA business.
So Yeah, I mean, I think the story I shared earlier about We Work Remotely or Dribble, those were both relatively small businesses. I mean, one was a $10 million acquisition, the other was a $1.5 million acquisition, and in both cases, those have grown, very significantly. And so I think it's easy to dismiss those businesses because they just seem small. And if you have a mental model that comes from the brick and mortar world, it's very difficult to take a 500K brick and mortar business and scale it in 4 years to something that is doing $3 million of EBITDA, right? Because the nature of the physical world is just you can't build a facility quickly or hire people or whatever. But with digital businesses, if you identify a business that's under monetized or where there's levers, you can basically grow it infinitely within 6 to 12 months. So, for example, with Dribble, if we looked at it and we said, okay, on a per user basis, we're making 5 cents per user per year, and we're confident that we can take it to 20 cents per user per year, it's irrelevant what the earnings are when we buy it. It all comes down to how certain are the levers that we can pull. And if we believe in those levers, then it's a no-brainer to buy that business and scale it significantly.
Another tweet. So you managed and worked with a lot of people, and this is, I think, oftentimes like what makes or breaks the businesses if you listen to the stories. So you mentioned there are two skills you must master to become successful in business. And no, I'm not talking about Excel or accounting. Number one is psychology. 70% of business is reading people. And number two, dealing with high conflict people. So my question to you, what are the solutions? And is there a way to get better at this other than experience?
So I think I often joke that Chris and I are like therapists. We've gotten really good at mirroring people. Someone tells you a problem and you say it back in a way that shows that you understand with empathy, or not pushing your ideas on somebody and instead using questioning to lead them down a path, or those sorts of things. And I think those are just basic psychology things that are incredibly helpful because, I made the comment earlier, businesses are not spreadsheets, they're groups of people. And so if you're not good with people, you're not going to be successful in business. And I think that ultimately being able to go into a meeting and say, hey, there's a problem and we should solve it in this way. And then being able to read someone's face and say, Chris and I will often walk out of a meeting and say, that CEO is not on board. And because they're not on board, they're not going to execute on what we want. And we have to try another strategy with them. And so it's a lot of that sort of thing. And then on the flip side, also, I think having a very good spidey sense for what types of people will be difficult to work with is very important. And so, we've had some experiences where we've worked with people who are highly emotional, paranoid, sometimes narcissistic, psychopathic. These are people, in various different roles, or even in, like companies we've just made small investments in and stuff. And we just want to avoid dealing with high conflict people in general. And so I think being able to flag those traits when you see them, it's a little bit like when you go on a first date with somebody and they're rude to the waiter, you go, you should go, I'm not going to date this person, even though it's just this tiny little thing. I know what that leads to. I know what that most likely indicates about their personality. And I think that same thing applies in business, not with waiters and waitresses necessarily, but just little tells that you need to learn in order to avoid the difficult people.
I have a few more tweets. I always like to read those because this shows how a person thinks, and that's why I would like to share this as well. And this is pretty much your thoughts on pricing when it comes to business opportunities. One of the worst kinds of businesses is one that sells something to a price-sensitive customer. My nightmare business is a software company that creates software for school teachers to help them manage their class schedules. So what have been maybe your own mistakes when it comes to starting businesses or investing in businesses that are doing this mistakes, or have you made any?
Yeah, I don't know that I have actually. I just have I always, whenever I go up to speak at the university locally, I find so often people pitch me on businesses to sell an expensive service to someone who doesn't have money, right? And the teacher example is apt. I think that ultimately the easiest types of businesses are when you sell something that to wealthy people or to companies that they actually want, and it solves a simple problem. And I think that if you think about it, like I'd much rather have a simple software product that's like a basic widget. Let's say you could build like a calendar scheduling widget, right? Now, it's pretty easy to build. It's pretty cheap to operate. And if you sell it to businesses, you can charge $100 a month. And if you sell it to school teachers, you can charge $2 a month. Which of those customers do you want? And which of them sticks around longer? And which of them complains less and has less support burden? I think the company. And so I think, not enough young entrepreneurs think about that. And it's often easy to just pivot your idea slightly and sell it to a different customer.
Now, another one. So you've quoted some time ago, always take the high road. It's far less crowded. Knowing this quote for some time, what have you done yourself in order to follow this advice?
So yeah, it's a Charlie Munger quote. And I think that life is so much better and you'll be more successful if you have a good reputation. And I think that a lot of the reason why people sell to us is because we have a good reputation for not ruining companies or treating people badly or screwing people out of, deals based on little terms or that sort of thing. And so for us, one of the simple things we do is sometimes if we look at buying a business and the counterparty, the founder, spends a lot of time going back and forth with us, and then we pass, we'll just pay their legal fees. We paid $50,000, $100,000 of legal fees for someone, and it was, they were annoyed because we backed out of the deal, but it was just this little thing that we did to just be nice. And I think going that extra mile to just try and make sure that you leave people with a positive impression of you goes a very long way, because it probably took that person from saying, I hate those guys, they wasted my time, to, you know what, we didn't do a deal together, but they were good guys, they took care of me in the end. And so we don't always do that, but those sorts of things I think go a very long way. And then I also think that there's opportunities in business to take advantage of certain situations, right? You can price gouge. I recently downloaded an app on the App Store, and it's like kind of a competitive app to something that we own. And when you sign up, it says free trial, but then it renews at a crazy price and bills you like insane for, and I just go like, I don't want to make money that way. I don't think that is a good way to make money, and I just want to avoid that. And would that make me rich faster? Yes, but I don't want to be known for that. So I think it's simple stuff like that. And I think, Warren Buffett is able to buy the world's best businesses because of his incredible reputation. And I think that protecting your reputation is everything.
You've met and probably being influenced by some of the entrepreneurs. I'm mentioning the names, and maybe you can share some of the things you learned from them. Number one, you mentioned before as well, is Jason Fried, and making this a bit easier for you. What have you learned from Jason's philosophy on simplicity in business and his approach to saying no to opportunities?
I think the whole reason that I got into business and starting software companies and all that kind of stuff was just watching Jason and David build their business. I was always so jealous of them, and I still am. I think Jason, more than any other entrepreneur, is so good at only doing things that he wants to do intrinsically. And if you look at how he runs his company, he has created this very strange, unique culture where it perfectly matches his personality, and the products reflect him. And at no point has he ever taken the low road, right? He never does something because it makes business sense. He does things because it's the right thing to do for the customer and because he and David want to do that thing. And I think that the way that they've gone about building their business is just incredibly unique and inspiring. I did a podcast with Jason maybe like 6 months ago, and I just left that podcast feeling so like excited for him and happy for him because he's really stuck to his guns and just done his own thing. And all these other people who, came up around the same time may have gone off and become billionaires and had public companies, but I just don't think they're as happy as he is. I think he's just got the world's best business for his specific personality, and that's really cool.
Another guy who comes to mind now is Sam Parr, My First Million, and he pretty much has built this media empire, and I'm following him on Instagram as well, and he seems like a very happy and relaxed guy. So what have been maybe some of the lessons from him? Because you've been interacting quite a lot. I've seen that.
Well, I don't think Sam was a very happy guy 5, 6, 7 years ago, right? I think he's a total stress case and running his business in a stressful and chaotic way. And I think, I assume he would probably say the same thing unless I'm totally off base. And I think what it's been cool about watching Sam is that he's really mellowed and gotten to a point where he has enough money. He focuses on the things he's really, truly great at, and he has a lot of focus. So he's focused on, family. I think he's a great dad and really focused on that part of his life. He's focused on being in great physical shape. And then he's chosen a business that is highly intrinsically motivated in terms of connecting other people that very much aligns with his audience and his desires. And I think Hampton's an awesome business. I actually had a similar idea for a business and I always wanted to launch it. So when Sam launched it, I was very jealous. But yeah, I think he's doing an incredible job. And I just love talking to Sam. Like, he's just a buddy. He's a great guy.
What about Sahil Bloom? You did an event with him. He seems similar. I haven't met, I haven't talked. He has I think 2.5-year-old kid at home. He's fully focused on family and the businesses. He probably has much more and bigger things behind the scenes going on. What about him?
I mean, again, focus, right? I really admire people who can focus. I have ADHD and I'm always doing a lot of different things. I'm an inch deep and a mile wide. And that makes me good at a lot of things, but it makes it very hard to just wake up every day and know what's that one thing I'm doing. And I think both of those guys are very, very focused.
I want to come back to one thing you mentioned, and you've said that on your interviews as well. Never give away equity. At least don't do it for free. We discussed this a bit, but as you brought it out, why it is so important?
Well, I think that people don't quite understand that equity is forever, right? If I give you 1% equity, every time I earn $1, you're getting 1 cent forever. And that's a lot to give up. And you may only be involved in the business for 3 years, but the business might go on for 30 years. So do I really want to give up, let's say you have 1% equity. Do I want to give up 1 cent of every dollar for the next 30 years because you were involved in the business for 3 years? Now, sometimes it makes a ton of sense. The business wouldn't have started without you or something like that, but it's a big ask. And so I just like to make it a very serious conversation where if somebody wants equity, they have to come to the table with me and fight for it and buy in.
One of the last few questions. What are you consuming today to learn and to stay on top and to make sure the next move you're going to make is?
I find I've stopped reading the news. I mostly read business biographies, and I love the Founders podcast by David Senra. All he does is he does a 1 to 2 hour deep dive on a book that he's read that week. And usually they're business or kind of interesting public figure memoirs, usually of people who are at the end of their career or are already dead. And I find that, you can learn so much more by seeing someone's full arc, right? I think if you look at, it's like looking at a stock ticker. If you see someone at a moment where they're up, well, you don't know if they're going to go back down. And I think reading a memoir is interesting because you can really see, okay, that person was a crazy entrepreneur, but then when they were old, they had no loved ones and their kids hated them, and they ended up losing all their money or something like that. I think it's interesting to learn from someone's full life.
Okay, Andrew, let's wrap up with the famous five. How old are you?
I'm 38.
Favorite book?
The Tao of Charlie Munger by, I believe, David Clark.
What car do you drive?
Tesla Model S.
What's the best investment advice you've ever got?
Fish where the fish are. It's a Charlie Munger line, and it means don't go and look for fish in places that other people are looking. If you find a fishing hole and there's 100 people fishing for one fish, go find another fishing hole with some sleepy fishermen and lots of fish.
And last one, where can people find you?
Mostly Twitter. So the best place to go actually is my website, neverenough.com. And that will link you to my book, my newsletter, my podcast, the tiny website, and my Twitter. And most of my thoughts I'll post on Twitter.
Okay, Andrew, thanks a lot. This was 60 minutes well spent. I've never had anyone on the podcast who has bought 30 or more businesses. So thanks a lot for doing this.
Of course, man. Great to meet you.